Welcome to Chapter 5 of the Conduct and Practices Handbook course. In this chapter, we are going to be discussing the client discovery and the account opening phase. So first off, this phase does revolve around basically the universal rule that every advisor needs to follow, and that is the Know Your Client rule. So you must ensure that the recorded risk objectives and risk factors continue to be suitable for the client. That is something that is going to appear on the NAF, and you will need to put that on that application form. And you will need to periodically review those risk objectives and risk factors to make sure that they are still suitable for that client. Any material changes in a client situation will require the Know Your Client form to be updated. And this form also includes age, marital status, occupation, income and net worth, number of dependents, risk tolerance, investment objectives, investment knowledge and experience, time horizon, and the current investment portfolio composition, as well as risk level. So you can obtain important information about the client situation during the account opening stage. Now, there are some red flags that you should be aware of when opening a new account. If the client is reluctant to provide adequate information or supporting documents, this can be a red flag for someone who is trying to launder money or something as such. Documentation that appears to be altered or counterfeit is another red flag. Documents that are photocopies are red flags. Attempts to open accounts in other people's names, supplying information that seems vague or untrue, providing an address that is out of the local service area, providing a post office box address rather than a street address, providing a phone number where the client cannot be reached, reluctance to complete required documentation, and inquisitiveness about compliance and anti-money laundering procedures. So those are all red flags that you do need to watch out for when opening new accounts. Now, speaking about money laundering a little bit, so there are certain things on the NAF and certain procedures that you do need to follow to ensure that the client or the person who is setting up an account is not trying to launder money. So first off, foreign politically exposed persons, or PEPs, they are generally a bigger concern from a money laundering perspective than domestic political exposed people. And this is actually something you do need to tick off on the NAF. So that is a question that you will need to come across. Also, for corporate accounts, you must obtain information about both the entity and the beneficial owners behind the company. Now, beneficial owners, they are people or companies that own or control 25% or more of the corporation. Now, for non-resident accounts, dealer members must be familiar with the registration requirements of the countries in which they intend to do business. Now, it is also really important to understand the new account application form, or the NAF, and basically it does have three main purposes. So one main purpose is to determine the client's investment objectives and risk tolerance. That is a key area that needs to be filled out on the NAF. You must also judge the client's credit worthiness with this NAF, and it does help a lot with that. And it does help to identify any industry regulations that apply to this account. So RRs, they must complete a NAF before opening any new account. These applications include the client's identity, so their full name, address, SIN number, personal information, all of that kind of stuff. The client must also fill out personal financial information, including income and net worth, Investment objectives and information about the client's relationship with any publicly traded companies is included as well. And basically it does, as I mentioned, it does identify certain regulations to that account, and it will give the advisor sort of a guideline as to what they can invest or what they can recommend in that account. Now, there are different account types. First off, you do have the regular cash account. This is also known as a non-registered account, and it does require the client to deposit payment in full for each purchased transaction. You also have margin accounts, which I believe is talked about in depth in Chapter 8 of this textbook. But basically, what they do is it's when dealer members lend to the client, they lend them the unpaid portion of the market value of the securities at prevailing interest rates. The client must make an initial deposit of a specific portion of the value of the securities purchased. This initial deposit does depend on the margin rate, and a margin agreement must be completed before this type of account is approved. There is also delivery against payment. These accounts involve the purchase of securities and payment on the settlement date. So an agent is used to complete these transactions, who then delivers the securities to the client. Now, you also have receipt against payments, and they operate like the delivery against payment accounts, except that securities are sold by the client. The member receives the securities from the client and then pays the client in full. You also do have various registered accounts, such as RRSPs, RIFs, RESPs, TFSAs, LIRAs, LIFs, and the locked-in retirement savings plan. You have pro accounts as well, so all employees for a dealer member or a related company and any of their family members living under the same roof are considered non-clients, and their accounts must be flagged as pro accounts. Now, pro accounts, it is the name for an account belonging to a non-client, and basically it will make it so client orders are prioritized above pro orders or orders from non-clients, just to avoid that front-running issue. You also do have investment club accounts. So when setting up an investment club account, a specific document called an investment club agreement must be completed, and it contains information and signatures of all members of the investment club. One or more people must be authorized to give trading instructions, and it cannot be the registered representative unless it is a discretionary account. You also do have discretionary accounts and managed accounts, and they are actually quite similar with one key difference. First off, the discretionary accounts, this is where the discretionary authority has not been solicited, but where the client chooses to give it on a temporary basis. And that's the key to remember about discretionary accounts, is that you're giving, or the client is giving discretionary authority on a temporary basis. So clients must indicate the reason for requesting the discretion, and a discretionary authority is valid for 12 months. Registered representatives must have at least 2 years of experience in any product that is traded on a discretionary basis. Now, with managed accounts, investment decisions are made on a continuing basis by the dealer member or by a third party hired by the dealer member. So managed accounts grant discretionary authority on an ongoing basis, so it is a permanent arrangement. That's the key difference for the managed accounts and the discretionary accounts. With the managed accounts, the dealer member must also be approved by IROC or must be a portfolio manager. The client must sign a managed account agreement and must clearly indicate the client's investment objectives. Each managed account must be reviewed by a designated supervisor to ensure the investment objectives are followed. Clients can terminate the agreement at any time, but the dealer member must give 30 days notice. So it is really important to understand the difference between those two accounts, and it is something that you will probably need to know for the exam. Now, I do have some more info that I would like to discuss. First off is the idea of beneficial ownership. So IRAC rules deal with KYC requirements for corporate accounts, which state that the beneficial owners of corporate accounts must be identified. And that's really the main purpose for this beneficial ownership rule. It is for those corporate accounts. So any person who owns more than 25% of a company has beneficial ownership, and they must be identified in that corporate account NAF. Now with currency, so clients, they may choose to purchase or sell securities denominated in foreign currencies. Now you should check with your operations department to see which currency accounts may be operated in at your firm. Payment and delivery. So when a security is purchased, clients can either deposit money into their investment account, or it can be taken from their bank account with a PAC plan. These payments must be made within the specified settlement period. With special instructions, this is an area of the NAF, and it is intended to primarily accommodate special instructions. Special instructions may also say things like duplicate confirmations or such. Now with registrant information, so first off is licensing. As an RR, you may occasionally have prospective clients who reside in a province in which you or your dealer member is not registered, or an existing client that may have moved into one of these provinces which you are not registered. So if this happens, you must bring the matter to the attention of the sales supervisor to determine whether orders from this client can still be accepted. Generally, you do need to be registered in the province where your client does reside. Next is source of the client. So it is important to know how the client came to you and your firm, and this is a box that you will need to tick off on the NAF. So clients who are phone-ins or walk-ins, they may have a higher likelihood of being dishonest since you don't personally know them. Direct or indirect interest. So there are specific rules about RRs participating with clients in operations of an account. As an RR, you must limit such participation to situations where the other party is a direct family member, which you should fully disclose on the NAF. For discretionary account orders, they should be marked as pro orders only if the RR has some type of beneficial interest in the account. So next we're going to talk about insiders. So insiders, they are likely to be board members or part of the company's management. They're also likely to possess inside information from time to time. They may not purchase or sell securities of the issuer, which they have inside information. They also can't pass the inside information along to someone else or induce someone else to trade in the issuer's securities. Insiders may trade when they are not in possession of inside information, but they must file reports with the Securities Commission detailing their trading. Insiders must report their trades within 10 days after the date of the trade. Also, you have control persons, and basically this is people with control, and they have control if they have 25% or more of direct or indirect control. And control persons typically may not sell their company's securities unless they file a prospectus or other disclosure documents with the Securities Commission and stock exchange where the securities trade. Trading authorization, this can be placed on accounts if you would like, and basically it allows someone else to have authority to trade in the account. You must determine exactly what authority has been delegated. So your responsibilities are to the account holder and not the other person with the trading authority. That is something really important to remember as a registered representative. And when there is a power of attorney, other risks do arise, and you should make sure activity aligns with the account holder's objectives. So you are going to be sending all confirmations to both the account holder and the power of attorney, and check the investor's signature against other assigned documents. But the main thing with trading authorization, the main thing to remember is that your responsibility is always towards the account holder and not the power of attorney or not the other person with trading authority. In the text, it also discusses banking information. So banking info, it can be used to assist in the verification of a person's identity under the PCML-TFA. Also, client acknowledgement. So all documentation must be positively acknowledged by the client at the time of the account opening. The client's signature is preferred to basically just verify that they have acknowledged everything on the form. And when a signature cannot be obtained, other forms of acknowledgement like a documented phone conversation or an email from the client can be sufficient. So we're going to look at some disclosures next. So you do have relationship disclosure. So dealer members, they must provide all retail clients with a relationship disclosure document that outlines the account relationship and services to be provided to the client. So it must include types of products and services the firm offers, the account relationship to which the client has consented, the process the firm uses to assess the client's KYC info and investment suitability, when account suitability will be routinely reviewed, whether suitability will be reviewed in other situations, including market fluctuations, material firm and advisor conflicts of interest, a statement that future material conflict of interest situations where not resolved will be disclosed to the client as they arise, all fees associated with the account, the complaint handling procedures, which is just a brochure from IROC, and the reporting the client will receive. So looking at some specific disclosures, so there is a pre-trade disclosure of charges. So before a dealer member accepts instructions to purchase or sell a security in a retail account, other than in a managed account, it must disclose the charges the client will be required to pay. So basically just the commissions. In the case of DSC charges, it must disclose that the client may be required to pay a deferred sales charge on the subsequent resale. And you must also disclose trailer fees if you are using them. Disclosure when acting as a principal. So you must disclose if they are acting as a principal on every trade confirmation. So this is if the client is not disclosed, the client may rescind the contract. And must disclose its relationship with the issuer for any recommended security. There are some specific disclosures relating to different products. If you are looking at IPOs, the disclosure for that it is a prospectus. So investors in newly issued securities must be given a prospectus, and this will give them a detailed description of the security. It'll give its history, operations, and audited financial statements. For mutual funds, purchasers must receive the fund facts document prior to purchase. For strip bonds and strip coupons, all first-time buyers, they must be given an information document outlining the specific investment characteristics, so like price volatility, income tax consequences, etc. For insurance products, a generic disclosure document is required. And for derivatives, disclosure documents, they are required for each type of derivative, and they are usually given to the client when an options or future account is initially opened. There's also a disclosure for leveraged accounts. So this is required when a new retail account is opened, and when you make a recommendation to purchase with borrowed funds, or when you become aware that a client intends to purchase securities with borrowed funds. So the disclosure should include using borrowed money to finance the purchase of securities involves greater risk than using cash resources only. And if you do borrow money to purchase securities, your responsibility to repay the loan and pay interest as required by its term remains the same even if the value of the securities purchased declines. In terms of some additional documentation, you must provide additional documents that disclose the following facts. So real or perceived conflicts of interest, that the firm is in a relationship as an introducing broker with a carrying broker, the firm shares premises with a financial services entity, and you actually do need to disclose this even if you are doing insurance in the same building. You also need to disclose that the RR is an agent rather than an employee. Referral arrangements, including referral fees that may be paid. So some general documents. First off is the margin agreement. It's needed to set up a margin account. And it basically just explains how the margin account works. It will talk about the right to sell securities or close the account if the proper settlement is not made, if the margin call cannot be met. You also have the cash agreement. This is required to document the client's agreement to do business within industry rules applicable to cash accounts. You have the guarantee form, and this is required when an account is guaranteed by a person other than the account holder. The person who does guarantee the account must also be a family member for that person. You also have some trading authorization documents. So authorization for an individual's account. Full authorization allows the withdrawal of funds, whereas limited authorization does not allow withdrawals. And we sort of looked at this a little bit when I talked about trading authorization. And you do need to disclose what type of trading authorization and exactly what they can do. So you do have different levels, you could say. So again, the full authorization allows the withdrawal of funds, whereas limited does not allow withdrawals, but you can switch around the investments and whatnot. And you can restrict any investment activity. Example for a person trading stocks and a person restricted to cash settlement. Authorization for a joint account with right of survivorship. So at the death of either the joint owners or the entire interest in the account becomes that of the survivor. Authorization for a corporation, partnership, or trust. The legal documentation must state whether full or limited authority has been granted, and it must identify who has that authority. The authorization for an estate account. So upon death of a client, no instructions should be carried out on behalf of anyone until proper documentation has been obtained, even if that person does have trading authorization on the account. So you will require a notarized copy, or you may require a notarized copy of the deceased's will. Authorization for an account with discretionary authority. So IROC prohibits RRs from accepting authorization for discretionary accounts unless a discretionary agreement was signed by the client. So for managed accounts, a managed account agreement is required. Next, we're going to look at separate NAFs. So basically, a single NAF can cover all cash and margin accounts for one client if the objectives for all accounts are the same. But you will need separate NAFs if you are opening different types of accounts. So for example, a non-registered account and a registered account, you will need separate NAFs. Electronic signatures must be accessible by the other party for subsequent reference. It must be capable of being retained by the other person, must be organized in the same way as the specific non-electronic form, must be reliable in identifying the person, and the platform must be reliable. So you do need to meet all these requirements if you are looking at doing some sort of electronic signature for the NAF. And the client signature areas must clearly state the following: the type or types of accounts being opened, receipt of and agreement with the terms and conditions of any relevant agreements, and receipt of any required disclosure documents. So for client records, basically you will want the NAF. So prior to execution, you must verify that a proposed trade is within that client's investment objectives and risk tolerance, and you will find that information on the NAF. For portfolio record, this shows the client's current holdings and provides a quick reference when you are speaking to the client. Security cross-reference, this shows which client owns a specific security, and it enables you to contact all clients should something important develop in a specific security. Correspondence, so all correspondence received at the premises is deemed to be property of the dealer member, and you must retain it for client records. You should also carefully document all conversations and actions taken with respect to a client account. Records of orders, so full details of a trade must be sent promptly and directly to a client in the form of a confirmation. So basically that is everything for this chapter of the CPH course. Again, I really hope you are enjoying these reviews, and stay tuned for the next chapter.